Hi, I want to talk about the S&P 500's 9.52% gain on April 9th. An amazing day in the stock market, which is the third largest gain in history since they began tracking that in 1957. So this all came about today when Trump announced a 90-day pause on enacting the additional tariffs he created on Tariff Liberation Day on April 2nd, and basically scared the stock market because the tariffs were dramatically larger than the reciprocal tariffs he had been talking about the past 6 weeks against 60 different countries. And the methodology of the additional tariff was a formula that was pretty crazy that nobody had ever heard of, and it kind of resulted in an arbitrary large tariff on many of these countries. That sent the stock market screaming down and causing a lot of panic with everybody. I recently sent out an email to all of our clients and people we know to buy the dip on Monday, April 7th. The S&P 500 closed 17.65% from the all-time high set on February 19th. And the thought process that I had on that when we notify our clients now is a potentially good time to buy stock was not so much that we're calling the bottom of the stock market, but it's more based on the fact that when are you going to buy your stock? Do you want to buy it after it's gone up 20% or if it's gone down 20%? Remember, everybody, we're trying to buy our stocks cheap and at lower price per share. We didn't say we're trying to buy the stock at the lowest price. The stock market on Monday was moving very frantically up and down, and went down, I believe, around 21% intraday and closed down 17%. So very wide volatility. And so our thinking behind this was maybe we should buy some stock with some cash. If you have cash sitting in your bank account, then that's a good time to bring it in and buy some stock. The average recession is a 23% decline. So we're very close to the average recession decline. However, we've accomplished this decline in approximately 6 weeks since February 19th. So one strategy to handle this is to sell all your stocks when there's stress in the market, then buy it back later. Some clients are asking me about that. However, when I think about that, would be you're not going to want to sell when everything is good. You're not, and therefore there is no stress. However, when the stock market has dropped, then that's where the stress comes in. And a lot of times, especially with this situation, our thinking is China going to negotiate, which they countered back with additional tariffs. The U.S. countered back with additional, etc. Is Europe going to agree to negotiate? Is Canada, Mexico? So these large trading partners, we don't know what they're going to do, when they're going to do it. But our thinking was, if you get any good news from any of these major nations, then potentially the stock market could have what we call a face-ripping rally, just screaming up, which is what we saw on April 9th today, 9.52%. So another thought that clients are asking me is, Glenn, if the stock market is down 20% in about 6 weeks, we could have a recession. Absolutely. Maybe the stock market's going to go down 50%. So I don't think I want to buy any more stock today because I think it's going to go down 50%. My question to you would be, if it goes down 49%, we're not buying because we didn't meet your trigger to buy at 50. What if the stock market goes down 40%? We still don't buy. Then you're not going to buy any stock at lower prices. So instead of thinking of this as a all or none, I'm only going to buy if it hits this level, our suggestion is you take swings and you buy a little bit as the market is going down. So I figured about a 20% decline. That's a pretty good time to take a swing. Who knows if we're going to go into recession? Maybe we go down further. Another client had a question. Maybe this could go down 50%, kind of like 2008, where we went down approximately 55%. My thinking on that would be, compared to the 2008 great financial crisis where we lost the whole banking system, and leading up to that was several years of real estate gains where people were lying to get their loans, and taking out 100% loan to value, which means 0% down payment, or even sometimes saying, hey, I bought a house for $1 million. I want a loan for $1.1 million. And I'll get a 3-year loan or a 5-year loan that resets, thinking, oh, property prices are going to go through the roof. Therefore, what happened in the 2008 decline, I view that you had a tremendous amount of excess behavior in the stock market and the real estate market, causing tremendous stress when it didn't hold up. Then you lost a substantial amount of banks in 2008. Similar issues in 2000 to 2002, when the stock market lost 50%. Then what happened the 5 years before? It was the dot-coms. Hey, I don't need to sell to my next door neighbor in my neighborhood. I can sell to the world online. Therefore, individuals started getting on the stock market and saying, oh, I can just do this myself. And then they started to buy and bid up stocks tremendously for the 5 years prior to that. So therefore, I thought it's a little bit difficult to have a 50% decline because at this point, we didn't see that much excess in the stock market. So of that type in the 2008 or the 2000. Keep in mind, those of us that are old enough, we remember those very painful times of the stock market going down 55%, while this was only 20. And those two times is happening in a 10-year period has, I believe, permanently scarred a lot of us. So I want to talk about this slide of 2000. In this slide, I want to talk about what happens when the S&P 500 goes down after 2 consecutive days of 4.5% or more. According to Fundstrat, who's prepared this research, they've shown that this has only happened 4 times in history. And so if we analyze what's happened, for example, in 1987, the first day dropped 5.2%. The second day dropped 20%. That's what we call Black Monday. And so imagine you went down approximately 25% in 2 days. Another time was in 2008 when you had the scenario where November 6th, 5.3% decline and a 5% decline. So you can see we've listed the 4 dates, and then we've just triggered that for the 5th time on April 4th, where we had a Thursday, 4.8% decline and a 6% decline. This was after Trump surprised the stock market on Wednesday, April 2nd with this tariff liberation day that, oh, we're going to be tariffing a lot higher than a reciprocal tariff that he's been talking about. So when we look at, okay, those are some pretty bad days. It's only happened 4 times since 1950, going down 4.5% or more. In the next 5 days after that, and we look at each of those scenarios, up 1.3, up 0.7, up 19.1, and down 2.9. The average return after 5 days was 4.6%. If we look at 12 months later from the date of the event, what did the S&P 500 do? Up 22.4, up 14.5, up 45.3, up 54.9. So the average was up 34%. So my question to my clients and everybody we work with is, when do you want to bring your cash in to buy stock? When you feel good after it's up 20%? Or when you've had 2 very miserable days of declines of 4.8 and down 6%? So our suggestion to clients is when the news is bad and you feel miserable because you're looking at your portfolio values go down, down, down the past 6 weeks, looking for opportune times to either bring cash in from your bank account or increase your equity or stock levels in your portfolios. For example, some clients had 40% stocks, bring it up to 60%. And other clients had 70% stocks, bring it up to 90%. Other clients had 90, bring it up to 100%. So our process that we've suggested to clients is, should we do that all in one day? No, I don't think we should do it in one day, maybe over a couple days, depending on what the market conditions are, to average out our cost. If we look at over a 12-month period, the average return of those 4 dates, 34%, and you say, if we look back after this event, 12 months later, If your accounts went up 34%, I think you're going to be very happy that, oh, I'm glad I brought my cash or increased my equity to buy stock. Of course, past performance is no guarantee of future results. The next item I want to talk about now is the VIX 4-month minus the 1-month term structure. And what this is, everybody is potentially familiar with the VIX as the fear gauges, and it's how much protection is the stock market participants buying. And when we look at this and we say, okay, when you get into the red zone and a very red zone, then where is this? For example, in July 2024, the stock market dropped 10%, and you can see that decline. And then you see the pink shaded area of, was that a good time to buy stock? Meaning, was that around a low level in the stock price, therefore a good time to buy? We sent out an email in July of last year suggesting our clients, this is potentially a good time to buy. And where did the stock market go after that? For example, in August, September, again, there was a 5% decline. You had the VIX term structure in the red. We suggested clients, potentially it's a good time to buy. Then you have some volatility in and around the elections. And then most recently, minus 7.3. Therefore, this was a report on April 7th by Fundstrat, where they suggested we're potentially getting near a burned out stage in the market, and we think that the market could rally. So this was another item in our thought process of maybe now is a good time to put some cash into the market. I want to talk about the rule of 10 best days and some data prepared by Fundstrat. So I want to discuss what the S&P 500 has done, which is the 500 largest companies, has done if you just held your money in the stock market since 1928 and you did nothing. You made 8%. If you missed the 10 best days of every calendar year, then your annualized return is a minus 13% per year. Therefore, you need to be in the market as opposed to in and out of the market. If we looked at that from 2015, the average annual return from then is 12% per year. However, if you missed the 10 best days, your average annual return is minus 10%. Therefore, we advise our clients to consider staying fully invested based on how much risk you wish to take, that you and I would have a discussion to review where you're comfortable with and how much are you willing to lose. I think everybody's happy with making money, but I'd like to always focus on how much we could potentially lose and is this going to accomplish our goals or not. So it's very important to be consulting with your advisor to discuss, these are my goals. I have short-term, medium-term, long-term goals to find out which level of risk is most appropriate for you. I want to thank you for listening to my first YouTube video. I've been thinking about doing this for quite some time, but I want to start doing this to get messages out to my clients on a quicker basis. So some of these will be market oriented and what's going on in the stock market, and others items will be some different financial planning strategies that can help. If you'd like to hear more, please hit the subscribe button, and I'd love to continue providing this information.